Welcome back to the program here on Business Daily. Now, before the break, I said we'll be looking into the forbearance situation with the central bank. We see that the story was actually yesterday that the CBN ended the forbearance measures and asked banks to provide capital restoration plan. Earlier in June, we read that story about it taking place and ending at the end of the month of June. Now, in case you're wondering what this whole thing is about, we'll just give you some context today to give you an understanding of what that whole situation is about. Now, what was the forbearance policy? Sometime in response way back in 2020 to the COVID-19 shocks and the post-pandemic downturn, the Central Bank of Nigeria implemented forbearance measures. Now, these included relaxed capital adequacy rules, looser loan classification guidelines, temporary suspension of single obligor limits, permission to restructure loans without downgrading asset quality. Now, what was the purpose of this? It was to protect the banks and borrowers from a credit crunch and financial collapse during and after the pandemic. Now? Why are they actually withdrawing this forbearance now? The CBN believes that the Nigeria's banking sector must return to normal prudential standards. The forbearance now, what did it do? It actually masked the through health of bank balance sheets. It allowed some banks to underreport non-performing loans, NPLs, and created a false sense of capital adequacy. Now, because, there's been some things put up, some cushions given to you, you're doing seemingly well because of the cushions. Now, when the cushions are taken off, can you stand on your own? If that platform is taken off, can you be able to do better? Rather, will you be able, or can you do better on your own? So those are one of the reasons why they pulled that thought. Now, any of the policies actually meant to improve transparency and risk discipline, aligned with Basel III international standards, strengthen the long-term stability of the financial system. This also follows a broader regulatory tightening trend since, of course, when the current CBN governor, Yemi Cardoso, took over in late 2023. What are the banks now required to do? The banks are required to do a capital restoration plan. Let's start with that now. Banks that fall short of capital adequacy ratios must now submit quarterly capital restoration plans. This was one of the major headlines on dailies and on the media space yesterday. CBN asking for capital restoration plan. What does this capital restoration plan include actually, or requires? It means cost reductions. Now, changes to lending and risk strategy, asset sales or equity raises, business model reform. So the banks that had to get this forbearance, and who maybe due to the forbearance were churning out a lot of great quarter, finished the quarter one with this, quarter one like that. They're going to have to go back to the table, withdraw their plan, restructure their plan. Hopefully, this doesn't lead to job losses for people when we're talking about cost reductions in that sense. Now, if you notice, equally, when that news came out sometime in June, the banking sector really had a big hit in the stock market. They lost about 140 billion naira in the stock because of that whole story. People were kind of pulling out from trending with the banking sector. Now, disclosure and transparency is another reason what the banks are now required to do. So it means the banks must disclose provisioning levels under both old with relief and new rules, loan performance and capital structure, risk-weighted assets, and Tier 1, AT1 capital breakdown. Those are some of the things that the banks are expected to do. Now, some of the terms I have mentioned in this conversation this morning, would like to do give you a bit of an insight. In case you're wondering, what does single obligor limits mean? What does Basel III international standards mean? Now, the single obligor limit, that's the SOL, is a regulatory rule that caps how much a bank can lend to one borrower, who is the obligor, or group of connected borrowers. It is designed to limit concentration risk, that is the risk a bank faces if one large borrower defaults. Now, how does it work? Especially in Nigeria, this is for people who intend to borrow money from the banks. According to the Central Bank of Nigeria, a bank cannot lend more than 20% of its shareholder funds unimpaired by losses to a single obligor. For example, if a bank has 100 billion naira in capital, its maximum exposure to any single borrower must not exceed 20 billion naira. So you can see that. So the bank can't lend to one single person or one single entity more than 20% of its entire capital shareholders' funds. In special cases, like syndicated loans or government-related entities, exceptions or extensions may apply. But of course, they require the Apex Bank's approval. Now, why does this matter, and what does it matter, the single obligor limit? It prevents overexposure to large borrowers. It encourages loan diversification, protects bank solvency in case of borrower default. And we've seen this happen. We've seen quite a number of banks having to, dissolve or being bought over because their loan, it's too much, it's out there. They have so much out there and they've not been able to recover. It's affecting their capital base. Now, it aligns with the Basel II-3 risk management framework. So we'll get to that part. What does the Basel II and Basel III mean? Now, risk of breach, regulatory sanctions, of course, from the CBN, forced loan structuring or capital deductions, and reputational and financial damage. So those are the things that, what the SQSOL mean? That's a single obligor limit. How does that, affect, or what, in case you want to know what you're doing as a borrower, what it entails. So now if I'm going to borrow from a bank, they can't give you, maybe you need 35 billion and the bank's entire portfolio is about 30 billion. They can't give one single person more than 6 billion of that entire amount. Now we'll come back to what the Basel II and III international standards are. Now, going back to that conversation so that you could see what we're talking about. Now, it means that for now, there's going to be a temporary suspension of that single obligor limit. Now, banks are going to have to pause on that for now. That was what happened then, rather, actually, when the forbearance policy was in place. There had to be a pause in the single obligor limits. They had to be suspended for the time being. Apparently, maybe they could now give more loans and all that to people. Now, let's look at what the Basel III international standards. Basel III is an international regulatory framework developed by the Bank for International Settlement, BIS, through the Basel Committee on Banking Supervision. It aims to strengthen the regulation, supervision, and risk management of banks globally. Now, why was it introduced? It was triggered by the 2008 global recession. In case you don't remember that, I do remember that some people personal to me or close to me had the heat due to that situation, the global financial crisis that took place in 2008. And here in Nigeria, we saw a lot of banks had to start merging up to be able to stand firm. Now, which exposed how undercapitalized and over-leveraged many banks were. Now, designed to prevent another systemic banking collapse. So this happened after that event in 2008 to prevent that happening again. It wasn't just something that happened in Nigeria. There was a global thing. A lot of people lost their funds. Some people even did some funny things. Now, what are the core components of Basel III? It's a higher capital requirements. Now, banks must hold more and higher quality capital. And if you notice, at that time was when the banking sector, under the leadership of the current Emir of Kano, Salisu Lamidi Sanusi, when he increased the capital base to 25 billion naira. And of course, as I said earlier, banks had to come together to be able to stand, to be able to deliver their jobs. And of course, we saw some banks being bought over, some changing their names and all that. Now, focus on common equity tier 1, the most loss absorbing form of capital. Now, capital type CET, that's common equity, Basel 3 minimum is 4.5%. There's a lot of numbers here. Now, RWA. Now, what does RWA mean? That's risk-weighted assets, loans weighted by their risk profile. Loans weighted by their risk profile. If you're getting the gist of this conversation this morning, you can say that the banks mostly function by loans and repayments and all that. So tier 1 capital total 6% of the risk weighted assets, and total capital, which will be a T1 plus T2, will be 8% of the risk-weighted assets. Now, what's the leverage ratio of a Basel 3 is that a non-risk-based backstop measure. It is a non-risk-based backstop measure. Banks must keep a minimum of 3% leverage ratio, meaning capital must be at least 3% of total assets, no matter how risky or safe they are. Now, liquidity requirement says that liquidity coverage ratio, banks must hold enough high-quality liquid assets to survive 30 days of severe stress. Non-stable funding ratio ensures that banks fund long-term assets with stable funding sources. Now, counter-cyclical buffers, central banks, of course, can impose additional buffers during credit booms to curb excessive lending. Now, how does the Basel III affect Nigeria? We see that the CBN is actively implementing the Basel III to modernize Nigeria's banking regulation. Now, Nigerian banks must improve capital adequacy, issue instruments like 81 bonds, manage liquidity more tightly, submit stronger stress test results. Now, just before we go, because time is not on the side, what does 81 mean, really? Now, before I get to that conversation, why does it matter and what are we expected to do? The removal of the forbearance led to declining bank stocks, the NGX all-share index dipped, and wiping out 140 billion in market value. However, the CBN and analyst Moody's Fitch view the shift towards stricter oversight and full transparency, and is fundamentally positive for its long-term financial sector stability. Time is not our friend. We had so much we could talk about today, and hopefully we'll have the financial expert or banking sector expert to give us more insight and talk about this with us in subsequent episodes of the program. Thank you for joining us this morning on Business Daily. That's the much we have for you from all of our programs, news and documentaries. Do well to follow us on our social media platforms and on our YouTube live stream. I've been your host this morning, Chiamaka Nwafor. Bye for now.